How do you take profit out of a limited company in a tax efficient way?
Well, it all depends on your goals, be it taking passive income, saving for retirement, or gaining financial freedom.
In today's episode of the Property Tax Show, we examine the four most common goals of property investors and share the tax strategies we'd advise for each scenario. Welcome to the Property Tax Show. I'm James Poyser.
And I'm Nadeem, Head of Tax at Provestor Accounts.
And in our most recent episode, we spoke about buying properties through limited companies. And so let's imagine, Nadeem, the landlord bought a property through a limited company, and now they're picking up the phone for you for some tax advice saying, hey, Nadeem, I've got this profit. I want to get it out of my company in the most tax efficient manner. Help me. What do I do?
Yeah, really common question, James. In terms of actually how you take money out tax efficiently, it really depends on what type of investor you are and actually what your kind of long-term goals are. And commonly when we have consultations with clients, the typical kind of plans clients have are generally for retirement, you have for financial freedom, passive income, and one which is becoming more and more common is just for legacy, for children to pass on to.
So you're saying as a tax advisor, actually, you talk about the goals, figure out what you're trying to achieve, and then you mould a tax strategy based on what people want to achieve.
Exactly.
Cool,
Yep.
right, okay. So in which case, so out of those four things, let's say explore passive income, right? So somebody's got a day job, got a property portfolio, want a bit of extra cash, perhaps for holidays, nice car, whatever it is, a few luxuries. So an investor's in that position, how do they access that profit in an efficient manner? What would you say to them?
Yeah, and again, this is where we talk about case-by-case basis. I know you like me using that term, James, but actually we do need to look at the case-by-case basis because every individual's own personal circumstances will be different to everybody else. So if you already have a full-time job, for example, where you're earning, let's say, £70,000, you're actually already a high rate earner paying 40% tax in your personal name. If you then decide to take any income out of that company, you'd be paying tax at the higher rate. So whether that's income tax in the form of a salary out of the limited company or dividends at 38.1%. So you can see the double taxation issue that we keep referring to here can become quite expensive if you have a desire to have passive income coming out of the limited company as well as your employment income. And this is where we have strategies in place where we introduce other family members potentially in the company who may well not be high earners, and we can maybe have tax planning ideas to actually extract money and remunerate them in a certain way. Okay,
brilliant. Okay, that makes sense. Okay, so that's passive income. The next one you mentioned is financial freedom. So I mean, well, first off, what's financial freedom? What do you mean by that?
Yeah, so financial freedom is a goal which we all have. We all don't want to work anymore. We want to be at home and live off our property portfolio where we don't have to do as much as we want to be doing. Yeah. And what that allows us to do is effectively build a portfolio up to a level which we can live off. So it means you can completely give up your other forms of income and rely on your income from the limited company alone.
Okay, so from a tax planning point of view, so again, somebody calls you up, Nadeem, and says, right, my goal is passive income. How does that advice differ to somebody who just wants, just a bit of extra cash to pay for a holiday?
Again, great question. Those who want the financial freedom and have no other income and effectively will be relying on the income from the limited company, we can have strategies in place where they take a small amount of salary out from the company and then amalgamate that with a certain amount of dividend payments, which are much more tax efficient if you're a basic rate earner. And like I said, it really depends on your lifestyle in terms of how much actually you want to extract from the company, because it could well be that actually you don't need necessarily to take too much money out of the income, out of the property company. So it really is a case-by-case kind of conversation, and in terms of what your long-term plans are with the company.
Yeah. And I guess there's a question there, isn't there, about when's the right time for people to take that leap into financial freedom? Because I'd imagine many landlords like to keep the profit inside their limited company to build that, the funds available. So when they're ready to make that leap and give up the day job, that they've got the right amount of money and profit sat in a limited company.
Absolutely. And the beauty of the limited company and you getting passive income out of your company is that actually you can flex how much money you take out. So you may take out more in 1 year and actually nothing in another year, which suits firstly your lifestyle and also your property building plans, because you may have a couple of years where you want to reinvest a lot of that money whilst you're building your portfolio up. Yes. But a couple of slower years where you don't really want to invest in any more properties, but actually take some money out and spend it on holidays, for example. So you really have that flexibility in terms of what your long-term plans are.
Yes. And I guess that's quite appealing compared to having a salary, where it's the same amount year in, year out. But that to think, actually, I don't need so much this year, but to keep that money working hard in your portfolio and then draw down on it when you're ready to
Absolutely.
take advantage of it. Okay, so that's passive income and financial freedom covered. I guess financial freedom for many people is about trying to bring forward their retirement a little bit, which feels like a good segue to talk about retirement and pensions. And you mentioned that's another common goal that people have. So let's talk about that. So if your goal is about trying to build up your pension pot and having a really brilliant retirement, what's your advice from a tax point of view when it comes to a property portfolio helping with that goal?
Yeah, so again, the retirement, you're absolutely right. It follows on from the financial freedom, and actually what that allows people to do is actually plan the way they can actually take money out of the company whilst they're still building up their portfolio and put into sort of, quite tax efficient pension schemes at an early age, as well as actually giving them a solid retirement. So people are clearly losing faith in certain pension schemes or the pension plan, as it were, and actually see more security in properties. So whether you're thinking of actually retiring early or not, pensions and properties tend to work well together because people know that they're getting a solid return on properties. Yes. In relation to your question about actually other flexible things that they can do, there are certain pension schemes that they can put into place which actually gives them much more flexibility in terms of retirement earlier on in their career.
Okay, so walk me through that. So you've got a limited company, you've got some property in there, it's generating profit, and your goal is to build the biggest pension pot. And you like the idea of being in control of your pension. Mm-hmm. And you've mentioned how you can reinvest it through vehicles. What does that actually mean? So give me an example. Yeah. What would that mean?
Yeah, so naturally this conversation would lead from a client who has a certain level of profits in the company and actually doesn't have much desire to take the money out and spend it on holidays and flashy cars. And actually what they're thinking about is their retirement and actually reinvesting that proceeds to make the portfolio even bigger. So what they can do is actually open what's called a pension scheme such as a SAS, which allows them to put the money from the company into the SAS, saving you corporation tax, firstly, at 19%. Yeah. So it will reduce your profits down. But it then allows you in that SAS the flexibility to invest in things like commercial properties, which you can then build in your portfolio. Yeah. And earn income from tax-free because it's within a pension scheme which is tax-free. So it's a great way of actually building your portfolio and saving tax at the same time.
That sounds like a pretty amazing catalyst, right? So to be able to take profit and, this is profit before corporation tax, to go into a pension pot that you're fully in control of, to reinvest back into your property portfolio to generate the profits, to build up your pension pot. That sounds like a real... Quite an exciting thing, right? If you're the kind of person who likes to be in control of your retirement plans and your financial planning, to have that degree of control and to reinvest that profit, sounds, really exciting.
Absolutely, yeah.
Brilliant. Okay, so we've covered those first three things, the passive income, financial freedom, pensions. There's also a question about legacy, children, grandchildren, and you mentioned that's a common reason why people are investing in property. Again, imagine, I'm a landlord, I'm calling you up, that's what I'm after. What's your approach for tax planning for legacy?
Yeah, so when you typically find legacy type of clients, so these are the people who are really thinking long term for their children and actually passing on their investment portfolio in the future. And typically they will not be interested in taking much money out of the company. So when we're talking about the double taxation issue, not really high on their agenda. It's more so about reinvesting the proceeds in the property company so they can build the portfolio up to a point where it can be passed on to their children, for legacy purposes, really. And those kind of conversations are a little bit easier because actually we're not talking about taking money out year on year. It's more about getting the company set up in a tax efficient manner so it can then be passed on to children, or any income that's been generating from the property company in the future can be given to the children in a tax efficient manner. Yeah. So the things that we do need to flag to clients to make sure it's set up correctly and making sure they're not caught by any HMRC's anti-avoidance provisions now in terms of introducing young children into the company. So very, very tax efficient.
Yeah. Okay. So specifically, so walk me through this. Let's say I'm a parent, got a young family, and I want to invest in their education. So we know, tuition fees are going up. Don't really want my kids to take out a student loan, and exit university with hefty loans. I want to be able to pay for their tuition from my property portfolio. How do we go about that?
Yeah. Again, a very common question. This is that we get asked, and there are ways to set the company up to allow certain payments and dividend extraction from the company, which can then be used for children and their education. What you have to be careful about is the anti-avoidance provision that's in place between children and parents. So again, a very common mistake is putting children, i.e. minors, as shareholders and paying them a small dividend, thinking it's going to be tax-free because they have no other form of income. However, if there are children, they will get caught by the parent-children trap which HMRC have in place, which means that if you do provide your children with any dividend payments, they'll be treated as if they are the parents' income. So it could be quite hefty in terms of penalties and tax for you there. So what we do recommend is things like trusts, or actually introducing grandparents into the company. What that gives you flexibility is in terms of how you move the money around the family in a tax efficient manner.
Yeah, brilliant. Okay, that's really good insight. I think it kind of drives home the message, right, that you might have these goals as a landlord, but it's really important right at the start of your kind of your career as a semi-professional landlord to think about these things and make sure the company's set up in the right way. Here's a kind of a last question for you then, Nadeem. So we've spoken about these four main goals. And what about people who don't yet know what their goals are? So perhaps they haven't got a family, they love their job. Why would they want to? Why would they want to give it up and have this passive income thing? But my point is, they don't quite know what their goals are going to be. They don't want to take any cash out of the limited company. They just want to focus on the growth of the portfolio. Tell me about that from a tax planning point of view, specifically about buying through a limited company.
Yeah, and that's a good question, because you'll find there's a growing trend of these type of people, especially the younger investors. And I think this is where professional advice is really required, because actually we talked about the beauty of a limited company and how it can be tax efficient year on year, and your plans can change in terms of what you take out and what you don't take out of a company. And this is a classic example of that, because actually if you have an investor who has short-term plans which may change in the medium term, then you have flexibility in a limited company to introduce shares, remove shares, add partners, remove partners, with potential tax consequences, mind you, but there's flexibility to change your planning in a limited company as your company grows. So it doesn't restrict you entirely. In fact, there's more flexibility in a limited company, because the limited company is owned by shares, and shares you can actually dilute and pass on to family friends. Whereas if you own a property in your personal name, it's very hard to dilute one property into pieces. So there's much more flexibility in terms of a plan you might have in a limited company.
Yeah. And I think this, just to summarise, I think this goes back to what we've said in a previous episode of the show, which is thinking ahead about your property portfolio. Think about the potential value and where it could get to, and taking a moment right at the beginning to take a breath, take a pause, think about where you're going, get the right advice if you need it, get the structure in place and get your company set up.
Absolutely, yeah. We always talk about professional advice, and you get your professional advice once, get your company set up correctly from day one, and that will be a big step forward in terms of your property journey.
Brilliant. Thank you, Nadeem. Well, that's everything for today's episode of the Property Tax Show. I hope you found that useful. Explored some really interesting topics around the goals of landlords when it comes to tax planning and limited companies. If you've liked this video, please hit the like button, the subscribe button, press the bell so you'll get the alerts when the next episodes come along. As always, if you've got any questions, put some comments below. Nadeem's on hand, and if he can answer your questions, he will do so, if that's all right.
Absolutely.
And that's it from us, and hopefully we'll see you next time on the Property Tax Show.